Welcome back. The U.S. national debt is now so large that saying we'll pay it off is like saying that you're going to pay off your credit card by opening another credit card. Technically possible, functionally hilarious. Right now, the United States government owes about $38 trillion in total outstanding debt. That's every dollar of borrowing piled together. If you took that number and divided it by the roughly 340 million Americans, it works out to about $112,430 per person sitting on the books. Every year, the U.S. borrows more just to keep the lights on rather than eliminate the balance. The real problem isn't just that the number is huge, it's that for a government, pay it off like a mortgage isn't how the system is designed. You and I, who own households, try to shrink our debt until it's gone. Countries don't. They service it, refinance it, and roll it forward year after year. In practice, that means repayment isn't even the right word. So when people ask, can the U.S. repay its debt? The honest answer is, not in the traditional sense, but it can keep it going for a long time. Which raises the real question. If it isn't going to be repaid, how long can it keep going? And what actually happens next? Debt is one of those words that sounds simple, but it actually hides three very different numbers that get mixed together all the time. Once you separate them, the entire situation snaps into focus. It starts with something called the deficit. The deficit is how much the government adds to that pile in a single year. In fiscal year 2025, the U.S. spent roughly $6.8 trillion, while bringing in about $5 trillion in revenue. That gap, around $1.8 trillion, is the deficit. It's the amount that gets added to the balance this year alone. Simple math, politically painful math. This chart shows the difference between deficits and debt. Each brown bar on the left represents a past annual deficit, years when the U.S. spent more than it earned. Those stack up over time. Then you add this year's deficit, roughly $1.8 trillion in fiscal year 2025, and that gets piled on top. When you add all past deficits plus the current one, you get the purple bar on the right, total U.S. debt. Which brings us to the second layer. Debt, the total debt. Debt is the total pile of money the government owes right now. As of today, that number is about $38 trillion. Think of it like the balance on a credit card after years of swiping. It doesn't reset every January. It doesn't care about election cycles. It just sits there, quietly compounding. This is the distinction most people miss. The deficit is a yearly flow. The debt is the cumulative stock. The deficit is the new charge. The debt is the balance after decades of charges. Then there's one more layer to the debt that makes this harder. Interest. This is the part that turns an annoyance into a real problem. Interest is the price of carrying the debt. It's the minimum payment required just to keep the account open. In fiscal year 2025, the U.S. paid over $1 trillion in interest alone. Not to reduce the debt, not to build anything new, just interest. And it's out of control. As Wolf Richter phrases it, debt out the wazoo. That makes interest one of the largest line items in the entire federal budget, bigger than many whole departments and larger than categories people argue about constantly. Now here's where it gets really uncomfortable. Because the government is still running large deficits, it has to borrow new money, not only to fund programs, but also to pay interest on previous borrowing. That's not illegal. It's not unusual for governments, but it does mean the system only works as long as lenders believe the U.S. will keep making those payments. So when politicians talk about paying down the debt, they usually don't mean writing a massive check. They mean slowing how fast the balance grows while continuing to make the minimum payments and refinancing the rest. This is like saying you're working on your finances because you've memorized the minimum payment. And that leads to the only question that actually matters. If interest rates stay higher and interest already costs over $1 trillion a year, how long can that minimum payment keep rising before something else has to give? To understand why government debt doesn't behave like household debt, you need to understand one very specific tool: government bonds. Here's the plain English version. When the U.S. government needs money, it doesn't walk into a bank and ask for a loan, it sells bonds. A bond is just a contract that says, give me money today and I'll pay you back later with interest. These bonds are sold by the U.S. Treasury and they come in different lengths. Some last a few weeks, some last a few months, some last 10, 20, even 30 years. And the longer that promise lasts, the more interest investors usually demand, because more time means more uncertainty. Now, who buys these bonds? Well, pretty much everyone. Banks, pension funds, insurance companies, mutual funds, foreign governments, even regular people through retirement accounts. U.S. Treasury bonds are considered the financial system's default safe asset. They're used as savings, as collateral, and as the foundation underneath a huge amount of global finance. This is where the part most people miss comes in. Every bond has a maturity date. When that date arrives, the government owes the bondholder the full amount back. In theory, that's when you'd repay the debt. In practice, that's not what happens. Because the U.S. usually runs a deficit, it doesn't have a giant pile of extra cash sitting around when bonds mature, so instead of paying them off the old-fashioned way, it does something else. It rolls the debt. That means issuing new bonds to pay off the old ones. The old bond expires, a new bond takes its place. The total pile stays alive. This system works smoothly as long as investors keep showing up to buy the new bonds. When demand is strong, refinancing is easy and interest rates stay relatively low. When demand weakens, rates have to rise to convince buyers to stick around. And this is why confidence matters so much. The U.S. doesn't need to eliminate its debt. It needs to convince lenders that it can always refinance it. Lose that confidence, and things get uncomfortable fast. Interest rates spike, borrowing gets harder, and suddenly the minimum payment jumps every time the debt rolls over. Here's the slightly uncomfortable truth. This isn't a repayment plan. It's a permanent refinance loop. Or put differently, the debt only works as long as the market believes the next bond auction will go smoothly. That's why repayment isn't the right mental model at all. The real game is rollover, confidence, and rates. And the system holds together only as long as investors believe the U.S. can keep juggling under the big top. At this point, someone usually asks the same question. Okay, but who exactly is the U.S. in debt to? The short answer is almost everyone. The longer answer matters a lot more. A huge chunk of U.S. government debt is owned inside the United States. Banks hold it, pension funds hold it, insurance companies hold it, mutual funds hold it, retirement accounts hold it. If you have a 401k, there's a very good chance you already own U.S. Treasuries, whether you realize it or not. Another large chunk is owned overseas by foreign governments and institutions. Countries like Japan, the UK, and yes, China buy U.S. bonds, not because they love America, but because treasuries are the safest, most liquid place on earth to park very large piles of money. When you're managing hundreds of billions of dollars, safety beats ideology every time. Here's the part most people miss. These bonds aren't just investments, they're infrastructure. Treasuries are used as collateral all over the global finance system. They sit underneath bank lending, derivatives, trade finance, and currency markets. They're the financial system's version of concrete, boring, invisible, and absolutely essential. That's why the question, what if the U.S. defaults, makes people nervous worldwide. It wouldn't just hurt bondholders, it would break the plumbing. Now a quick myth-busting moment. China does not own America. Even at its peak, China held only a fraction of total U.S. debt, and that share has been shrinking for years. If China dumped its U.S. treasuries tomorrow, it wouldn't bankrupt the U.S., but it would cause market chaos, and China would hurt itself in the process. This is mutual dependence. Or put differently, everyone is standing on the same concrete slab. So when investors buy U.S. debt, they're not betting that America will someday pay it all off. They're betting on something much simpler, that the U.S. will keep rolling its debt, keep honoring interest payments, and keep functioning well enough that treasuries remain the world's safest financial building block. Which brings us to the next problem. If the entire system runs on trust, what happens when the forces pushing the debt higher never seem to stop? If you zoom out far enough, the U.S. debt problem starts to look less like a bad decision and more like a machine that's been set to on for decades. Here's the core reason the debt keeps rising. Most federal spending is on autopilot. Every year, the government doesn't sit down and renegotiate the entire budget from scratch. A large share of spending is already locked in by law. These are called mandatory programs, and the biggest ones are Social Security, Medicare, Medicaid, and now, increasingly, interest on the debt itself. Before Congress argues about anything, a huge chunk of the budget is already spoken for. Now, add demographics. The U.S. population is aging. Baby boomers are retiring. That means fewer workers paying payroll taxes and more people receiving benefits. In everyday terms, it's like a group project where more people are collecting credit and fewer people are still doing the work. That alone pushes spending up and revenue down, even if nothing changes. Then comes politics. To slow the debt, the government has exactly 3 levers: cut spending, raise taxes, or do some combination of both. Every option is unpopular. Cut spending and someone loses benefits, services, or jobs. Raise taxes and someone pays more. Try to do both and you upset everyone at the same time. So what usually happens instead is delay. Temporary fixes, short-term deals, kicking the can. This is why deficits don't disappear even during good economic years. And then there's interest, quiet, boring, and relentless. As debt grows, interest payments grow with it, and once interest becomes large enough, it starts competing with everything else. Eventually, it'll overtake every other financial budgeting. Money that could have gone to infrastructure, defense, research, or tax cuts instead goes to servicing past decisions. This creates a feedback loop. More debt leads to more interest. More interest increases spending. Higher spending widens deficits. Wider deficits add more debt. And here's the key point. That loop doesn't require reckless new programs to keep spinning. It keeps spinning even if politicians do nothing. That's why budget offices keep showing the same long-term picture over and over again. Without major changes, debt keeps climbing not because of one crisis, but because of math, demographics, and inertia. This is the uncomfortable truth. The U.S. isn't borrowing like someone in a panic, it's borrowing like someone who's built an entire lifestyle around refinancing. Up until now, this whole system had one very important thing going for it. Interest rates were low. For years, the U.S. could borrow cheaply. When old bonds matured, they were refinanced at similar or even lower rates. The minimum payment stayed manageable, annoying but not dangerous. Then, rates went up, and this is where the math starts to bite. Remember, government debt doesn't all mature at once. It's spread out over time. Some bonds expire this year, some next year, some decades from now. But every single year, trillions of dollars worth of old debt rolls over. When those bonds were issued during the low-rate era, interest was cheap. Refinancing them today means locking in much higher rates. Same balance, much bigger minimum payment. That's the trap. Even if the government didn't add a single new dollar of spending, interest costs would still rise, simply because cheap old debt is being replaced with expensive new debt. And this isn't theoretical, it's already happening. Interest payments have surged into one of the largest categories in the federal budget, not because the government suddenly went on a borrowing spree last year, but because the price of carrying decades of accumulated debt just went up. This is why higher interest rates are so dangerous for heavily indebted systems. Think of it like a household that built its entire lifestyle around a low-interest mortgage and cheap credit cards. Monthly payments felt fine, predictable, comfortable. Then the rates reset. Same house, same balance, a very different bill. Now zoom that out to an entire country. As interest costs rise, they start crowding out other spending. Budgets get tighter without a single vote being cast. And to cover the higher payments, the government often has to borrow even more, which is how you get that phrase people love to throw around, debt spiral. Now, to be clear, this doesn't mean instant collapse. Governments can operate like this for a long time, but it does mean the margin for error is smaller than before. At some point, markets stop asking, is the U.S. safe? And start asking, how much compensation do I need to keep lending? Here's the weird part, and this is where most people's intuition completely breaks. If you add up all the dollars in the system at any given moment, that number is much smaller than the amount of debt those dollars are expected to service over time. At first, that sounds impossible, right? How can you owe more money than actually exists? The answer is that modern money isn't created first and then lent out. It's created by lending. Let me explain. You deposit $1,000 into your bank account. As far as you're concerned, you still have that $1,000. You can check the app, and it's right there. Now, the bank takes most of that money and lends it out, maybe to the government by buying a treasury bond. The government spends that money, someone else receives it, and that person deposits it into their bank account. Now pause. You still see $1,000 in your account. They see the money in their account, and the government now owes the bond back with interest. Same dollars, multiple claims. That's not fraud. That's actually how the system is designed. This process repeats over and over and over again. Banks lend, money circulates, new deposits appear, and every time this happens, debt grows faster than the physical amount of cash or base money. That's why total debt can tower over the money supply without the system immediately collapsing. $1 can support many promises as long as everything keeps moving. Economists call this velocity, how fast money changes hands. If the same dollars move quickly enough, they can service a huge amount of debt. But here's the catch. Velocity depends on confidence and affordability. When rates are low and income is rising, money flows easily, lending feels safe, payments feel manageable. When rates rise and debt service gets expensive, everything slows down. People hold cash, lending tightens, payments get prioritized, and suddenly the same system that allowed debt to expand starts working in reverse. This is why saying, just pay off the debt, completely misses the point. If everyone tried to deleverage at once, governments, companies, households, you wouldn't get a neat payoff, you'd get defaults, frozen credit, and disappearing money. Because when loans are paid off or written off, the money created by those loans often vanishes with them. That's the paradox. The real constraint on debt isn't the number printed on the bills. It's confidence, cash flow, and the willingness to keep the system rolling. At this point, we can finally ask the right question. If the debt can't realistically be paid down all at once, and letting it collapse would be catastrophic, what options are actually left? This is where things get interesting. When you strip away the politics and the noise, there are really only 4 endgames, not in theory, in practice. And in the real world, we usually get a messy mix of all 4. Let's walk through them. The first path is debt forgiveness or restructuring, sometimes called debt jubilee. The idea is simple. When the debt load becomes unmanageable, some promises get rewritten. Payments are delayed, terms are changed, losses are absorbed. On a small scale, you already see this with things like student loan forgiveness or corporate restructurings. At the government level, it rarely looks like an announcement that says debt forgiven. It looks more subtle. Inflation-adjusted losses, regulatory changes, balance sheets quietly taking a hit. Someone still pays. It's just the lender instead of the borrower. The second path is deflationary deleveraging. This is the painful one. Here, debt gets reduced because people can't pay. Defaults rise, spending collapses, credit tightens. Loans are written off, and when loans disappear, the money created by those loans disappears with them. Prices fall, asset values crash, unemployment spikes. The upside? Debt actually shrinks. The downside? Everything else shrinks too. This is what policymakers are most afraid of, which is why they usually try very hard to avoid it. The third path is inflationary deleveraging, the politically convenient option. Instead of reducing the number of dollars owed, you reduce the value of each dollar. Wages rise over time, prices rise, tax revenue rises, but the debt itself is mostly fixed in nominal terms. So in real terms, it becomes easier to carry. This is why modern inflation is often described as helpful for heavily indebted governments. It acts like a pressure valve. Savers pay through lost purchasing power, borrowers get relief. No default, no dramatic announcement, just slow erosion. The fourth path is growth and productivity. This is the cleanest option and the hardest. If the economy grows faster than the debt, the burden shrinks naturally. New technology, higher productivity, and real income growth make old debts feel smaller. This is what happened after World War II. The debt didn't disappear, the economy outgrew it. But growth like that is rare, unpredictable, and very difficult to engineer on demand. So here's the key takeaway. Every path solves the debt problem by assigning the cost to someone: lenders, workers, savers, asset owners, future taxpayers. There's no pain-free option, only different ways of spreading it out and hiding it. So the real debate isn't whether the debt will be dealt with, it's who pays, how slowly, and how harsh it is on people. Which brings us to the final question. Given where we are right now, which of these paths does the U.S. actually seem to be on? If you're hoping the U.S. neatly chooses one of the four paths and sticks to it, I've got bad news. That's almost never how it works. In reality, countries don't pick a single solution, they blend them, often without admitting it. The most likely outcome for the U.S. isn't a dramatic default or a clean debt jubilee. It's a long stretch of managed pressure. And that usually looks like this: a bit of inflation, even when it's unpopular. Not enough to cause panic, but enough to slowly erode the real value of old debt. Some attempts at growth, infrastructure, technology, productivity bets that may or may not pay off. Occasional spending fights and tax tweaks that reduce deficits at the margins without ever fully reversing the trend. And periodic moments of market stress that remind everyone the system isn't free. You can already see hints of this approach. Central banks talk tough about inflation, but also step in when the financial system wobbles. Governments promise fiscal discipline, then blink when the political cost gets too high. Ratings agencies issue warnings not because collapse is imminent, but because the margin for error is shrinking. This is the key shift to understand. The question is no longer, will the U.S. pay its debt? It's how much strain can the system absorb before investors demand higher compensation. Because as long as markets believe the U.S. can manage the debt, roll it, service it, and stabilize it relative to the economy, the system holds. When that belief weakens, things move fast. So the smart way to think about the future isn't in terms of absolutes, it's in terms of pressure gauges. Interest costs as a share of spending, auction demand for treasuries, inflation persistence, political dysfunction, and economic growth. Those gauges tell you how close the system is to its limits. The U.S. debt won't be repaid in the way most people imagine. It'll be managed, rolled, inflated, grown around, and argued over. And the cost will show up somewhere else. We just saw who the U.S. owes money to. But here's the strange part. Every country is in debt. That shouldn't be possible, yet it is. Click the video on the screen to find out who the money is really owed to.